In this episode of the Red to Black podcast, we're discussing will Euphoria last forever? You see in the markets right now this euphoria for Bitcoin, for gold, for all sorts of other assets, housing. How long will that last? Stay tuned, keep listening, and find out. Welcome to the Red to Black podcast with your hosts, Warner and Mario. And today, Mario, we're going to discuss euphoria in the markets. Will it last forever? What are your thoughts?
Simply no.
Interesting. Can you expound on that?
Yeah, Warner, it comes down to, yeah, absolutely. It comes down to price. So as you have more euphoria, people are paying a higher and higher price for assets. And those assets, when there's a bump in the business cycle or in the economy, are unable to pay to service the debt plus interest. So if you're chasing asset prices higher and higher and higher and higher, and you run into a little bit of a roadblock, you're unable to make that debt service payment plus the interest that's needed to keep that asset. So you're going to see negative returns on real assets. Assets are going to actually start returning negative returns because of the price people paid. Not that the asset's bad. Assets aren't good or bad, really. It has to do with the price you pay. At the right price, almost any asset is a good deal at the right price. If you're paying 1 times operating income, you can be in some pretty marginal businesses. We're not advising that, but those assets will actually work out. When you're paying these enormous prices for assets, think multifamily property in Santa Monica at a 3 cap rate or a 2 cap rate, it's actually going to return a negative yield on a long enough basis, 12-year basis, if you adjust it for inflation. What are your thoughts on that?
Yeah, so these low interest rates are creating an environment where people are going to take on a lot. Risk is on. And you've talked about this before. When you have cash in your hands and you can only, let's say you're restricted just to buying with cash, then you're going to think a lot differently than if you have debt underneath it, propping it up. So a few examples in the real estate market, in the housing market, it's going insane right now because there's a euphoria and a fear of missing out and this fear of inflation coming with low interest rates. So people are piling into those markets. Also in other markets, you have all sorts of money coming in through the Federal Reserve to these companies, and the companies are buying back their shares because they can get, how's the money going to the companies? The companies are able to take out short-term debt with that money and at a really low rate. And the CEOs are like, we have good cash positions. Some of them don't. We have really good rates. Let's take that and buy back our shares. So you have this underlying free money, which is getting people to go risk on when otherwise they would be risk off or risk assessment. And that's the challenge we're coming into. When that money, like the blood in the system, pulls back, it's like a transfusion coming in. When that transfusion comes back, then you're left with, well, how is the system really going to operate? The great companies will stick around. The poor companies, no more money, no more business.
Yeah, so credit disinflation is the tide shifting. So when the credit system is contracting, that blood is going outside the body, and it's horrible. It's horrific. It's going to be a horrific scene for the people that have taken on debt. If you've paid cash for an asset, you can always hold the asset and ride it out. When you're trying to make the asset pay the debt service, you're in a nightmare situation.
Yeah. So what that goes back to is what we always talk about, and we keep going over and over this because, like anything else we learn in the Marine Corps, repetition is what builds that motor skill, which builds that foundational approach that supports you in being better and better in your performance. And the performance of a business is essential. And that's what most people forget. When money comes into the equation, it's like the rational thought goes out the window. It's like, oh, I got to get into Bitcoin. I got to get into gold. That's fine. But do you understand the underlying value of those assets? Meaning, can you go in and say, here's the cash flow statement. What is it producing? What am I willing to pay on those cash flows? That's straight up like at the core performance. And most people are not looking at that because there's euphoria, there's free money or almost free money. There's fear of missing out. There's a tip from your buddy. All these things are overshadowing or deceiving you into thinking this is a great business when you haven't done the analysis. And here's the thing. There's baseball teams that I forget what, there was actually a movie done on it, but there's a baseball team. I don't know if it was the Los Angeles Dodgers, but they actually, the managers of the team was like, you know what? I don't have this budget to pay for these players. I'm going to go into the numbers and figure out what actually is going to create results. And I forget what it was, but he found a certain statistic like on base or something. Do you know that? Can you take up with that? Yeah, go ahead.
It's Moneyball. It was, I think it
Moneyball.
was
Yeah, go ahead.
Oakland A's up in the Bay Area. So they actually looked statistically at what wins games, and it's on base percentage. So batters, not necessarily that we're getting home runs or stand up doubles or even getting single hits on base. It's actually just a guy that could physically make it to first base. So walks, getting hit by the ball, and so they were going into the minor leagues and finding some what appeared to be real bizarre players. But these guys they could get on base. Their on base percentage was the highest, and consistently year after year, they'd played professional baseball, at the minor leagugues, and they went in there and paid pennies for these players to bring them on, and they started becoming very, very competitive. And a gentleman wrote a very interesting book on it. So yeah, Moneyball. That's how to win in this game. Is there's a couple of books to read. Moneyball, the Hidden Champions of the 21st Century, Moneyball, and The Intelligent Investor by Ben Graham. Those three books, if you can read those and actually conceptualize them and then put them into practice, you win. You're going to win long term. Going back to asset prices and overpaying, there's something called a Z-score, and it's an economist and accounting professor who came up with it, and it predicts very accurately a company going bankrupt. And basically, the lower the Z-score, the more likely a company is to go bankrupt. And it's very accurate. It's a very good indicator if a company is going to go bankrupt. But it boils down to free cash flow. It boils down to net income, the business generating income in relation to its debt. And what you're seeing now is you have companies that have a lot of debt and very little income, and they're statistically likely to go bankrupt, and they will. Eventually they will. The debt dries up. The banks don't want to lend anymore, and they're not able to service the debt. Show's over. They're going to liquidate that at bankruptcy.
Yeah, so what's happening right now is because some of these businesses are being propped up, like if you go onto the stock market right now and look at a lot of the new IPOs, with one exception, Facebook, I would say, they were making money off the bat, decent money, like 30% margins. I remember you and me looked at it, I think when they first IPO'd or a little bit afterwards, but they're the exception. If you look at most other businesses, they don't make any money. So you ask the question, well, how are you making money on the public markets? Oh, they're issuing more shares because shares right now are elevated, right? So they can get a lot of money from issuing shares because of the euphoria. I mean, Pinterest did 7x since the last dip in, what was it? When's the last dip? March 2019? I completely forget. Do you remember?
2020. I think it would be March 2020.
Is it March 2020? Okay, 1 year forward. March 2020, when they had that huge dip, Pinterest after that went up like, I haven't checked them recently, it was 7x. So you're asking yourself, how is a company that makes no money going up 7x? Euphoria. The company's going, well, we make no money. Oh, let's issue more shares. So now you're diluting your shares. Whereas a great company like Oracle is buying back their shares. So you have these economies of scale that are not going to work when the whole thing comes apart, because this company is going to go, oh, I was paying you to work here, and now the share price is 75% of what it used to be. I can't afford 75% of you because that was my revenue. It was cash flow from financing. It wasn't cash flow from operations. And that's what people don't get. That's why the euphoria, what Mari and I are talking about, is the behavior has been swapped with the cash flow statement. And it's creating this environment that's just going to at some point, if you look at the Weimar Republic, you look at the Mississippi bubble, you look at the tulip bubble, at some point, it will get overextended and it will go off a cliff. Like they say, bulls climb the stairs, bears jump out the window. That's coming. So I've heard that one a lot lately. So that's it for this short episode. If you guys love what we're handing out here, please comment, please share it with your friends, please subscribe, and we thank you for your time.